Good evening, everybody. Luke Gromen, FFTT. Hope everybody had a great weekend and that nobody went home on Friday short a bunch of oil. Going to jump right in here to the two things that grabbed our attention recently. The first thing, we've talked about it won't matter till it matters. We've talked about how in the geopolitical and economic setup we are in, most market participants are assuming the contiguous markets, there'll never be any limit up days, months, or weeks, months. And so I think the first thing is the way oil opened after closing on Friday should serve as an important reminder. Go back to the history books. Check out what happened at times in the 70s where you would have certain commodities go limit up, no volume done, go home, come in the next day, limit up, no volume done, go home. This can go on. And so I do think it's interesting from that point. In terms of the Saudi attacks themselves, can't get into too many details at this point as we've got a special report coming out for subscribers tomorrow, but I think you have to look at cui bono, who benefits or to whose benefit, right? And so clearly, all else equal, U.S. wins, China loses in terms of the main thrust of a spike up in oil. I think that's pretty well understood. What I'm not seeing a lot of discussion about are the potential second derivative impacts, and I think that is where a lot of the real money is going to be made going forward from this point. So the second thing that grabbed our attention was a tweet last week from Zero Hedge. In 1 week, the Fed will cut rates with the S&P 500 at all-time highs, which warmed our hearts a bit since it's exactly what we wrote would happen back on April 30th of this year, as once we noted that Fed funds rates being over IOER, which began on March 20th and has persisted, meant that the dollar shortage had reached U.S. shores, and in particular the U.S. banking system, and that from that point the Fed would have to begin moving towards injecting dollar liquidity in order to begin effectively to finance U.S. deficits. This is happening. It's still not that well understood yet, but you're starting to see more establishment economists, Fed economists, for example, just asking questions, why are primary dealers buying so many treasuries? So, it's something that we've called Voldemort. It's something that once you see it, you can't unsee it, but I don't think we're at the 100th monkey, so to speak, in terms of the number of market participants seeing it, but we don't think we're far off. So with that, we're going to jump into a few questions. First one from Tariq. Do I have a year-end price target for gold? I don't. For me, it's crystal clear we're in a global sovereign debt bubble. The bubble is starting to burst. The last two times we were in a situation like this, the price of basically all other assets fell versus gold. And so for me, it's my biggest position. It has been my biggest position for some time. I sleep with it I sleep very well having that position on, understanding sort of the big picture, the forest for the trees of when global sovereign debt bubbles burst, it's good for gold. From McFly, do you see the prospects of quantitative easing without reduction of federal funds rates to zero first? I think it's possible. I think it depends on how events play out, but I do think it's possible. From Jared, how do you perceive a 25 basis point cut this week will be received by markets in the near term? I don't think 25 basis points is enough. This dollar shortage in the U.S. banking system, I think, continues to be and globally continues to be an issue. I don't think 25 basis points enough. I think they'll probably do 25 basis points, but let's see how that plays out. We'll know pretty quickly in terms of how markets react. From Max, in tree rings, you favored U.S. value in emerging markets for equities. This has been a big winner the last 2 weeks. Is it simply short-term win due to quant quake and the Momo rotation narrative, or is the market starting to sniff out the FFTT, the long-term FFTT themes of the U.S. fiscal situation and how the Fed's got to handle it? That to me is a $64,000 question. My gut tells me it's more technical quant quake Momo related sector rotation. But like I said earlier, you're starting to see more getting close to understanding the Voldemort problem, the U.S. fiscal situation, and what that implication will ultimately mean. So I don't think we're very far from it being driven by more of the liquidity side. From Maziar, how much value do you give to the gold commitment of traders activity? What does it tell you, and do you think it's it's as good of an indication of where gold is going? I had I have a relationship I've developed with one of the biggest physical gold traders on the planet by virtue of a mutual friend and some of our work. This gold trader told me about a year and a half ago that 20 years ago the commitment of traders report was very, very tradable. And that in his view, it has become less tradable these days, in no small part because he said that there's some gray area about how certain reporting entities can be classified. So commercials can be commercials or specs, depending on how certain brokers want to classify an operation, basically. And so I'm not saying it's not useful, but I think it's important that in the view of this trader, that it can be used to paint a picture so that you can see what maybe somebody else wants to see. Let me see here. From RSOC, can you give a general hypothesis of what's happening with U.S. Treasuries? Sure. I think foreign central banks stopped buying treasuries on net in 3Q14. I think in October 18, FX hedge treasury yields went negative due to some regulatory changes. That basically meant foreign private sector buyers were beginning to get paid not to buy treasuries or roll them, at least if they wanted to hedge the dollar. Since 2Q18, the slack has been picked up in no small part by the big banks, and in particular 3 big banks who financed around 25% U.S. deficits since then. That dynamic began to crowd out the U.S. economy. U.S. economy slowed. That then kicked off a duration / flight to safety trade, and then ultimately, this is going to result in the Fed needing to inject dollar liquidity, which I think we're starting to get to that point, which may be why we're starting to see Treasury markets sell off a bit. We'll see. From Boric, how long have the Fed got before markets dismiss paltry 25 basis point cuts and start cries for QE4? I think the money markets are already shouting that they want more than 25 basis point cuts. We'll see how the equity markets react to that this week. From Matt, is there any plausible way that you see dollar hedging costs dropping or U.S. rates rising versus rest of the world to enable the U.S. to once again sell treasuries to foreigners? They can still sell them, but in terms of them being attractive to the foreign private sector on an FX hedge basis, you really have to either change the regulatory side so that FX swaps books can grow at U.S. banks again. That's a dollar liquidity injection, so that would be negative for the dollar. You'd have to get the dollar to weaken markedly. That would also normalize FX hedging costs. And that would then make treasuries attractive again on an FX hedge or dollar hedge basis to the foreign private sector. Or you could get the U.S. Treasury yields up much higher than they are. The challenge with that is that you're going to hurt the U.S. economy, which is already slowing in a pretty pronounced manner. So really, you got to get the dollar down. You got to get the dollar down are the fixes. And the final one is that from SD, Luke, any idea on motives why the U.S. financial powers that be would allow China and the CME to hook up, and the CME is offering a offshore yuan gold contract. It's going to go live October 14th. It'll trade in both dollars and yuan. To me, it has been a very curious question. The CME is a U.S. systemically important financial institution. It appears to be helping China internationalize the renminbi, which is obviously, given all other events and context, an odd thing to be occurring. So I don't have a great answer for that other than to say I'm watching it very closely. It's really probably a discussion for a longer format, unfortunately, in terms of what the potential reasons for that could be, and might even require a bit of a tinfoil hat on my part. So I'm going to leave it at that and jump. As always, if you want to see what we're up to, please go to FFTT-LLC.com and see what's going on. Check out Tree Rings, our weekly research offerings. Been getting great feedback. And otherwise, everyone have a great week and look forward to catching up soon. Take care, everybody.